Rob Subbaraman. He's head of emerging market economics at Nomura, who's joining us on the sidelines of this Nomura roundtable. Rob, good having you. Thanks so much for taking the time out. What's been the central theme?
Great to be here.
Yeah, thank you so much. What's been the central theme or the outcome of these discussions that you had? Does the think tank at Nomura believe that the stage is set for this party that we've had in 2017 across almost all asset classes to continue in 2018?
The short answer is yes. This Goldilocks economy of solid growth and still, puzzling low inflation. Our sense is it's this sweet spot is going to stretch into 2018. We have the US, the Eurozone economy, Japan, all growing above their potential next year. And yet inflation, we have, it's starting to rise, but very gently, because we still feel these structural disinflationary forces, particularly around the digital economy, is going to avoid a sharp rise in inflation. So it's a kind of Goldilocks continuing. I guess where we are a bit concerned is whether the major central banks, even though inflation is fairly low, could they start normalizing faster because of financial stability risks? That's a concern. We don't think it's Q1, but we think Q2, Q3 are higher risk quarters where we could potentially have some snapback, particularly around emerging markets, because of faster normalization by the Fed, the ECB, possibly even the Bank of Japan.
But it's already started to play out a little bit as well. I mean, with an assumption that next week we'll probably see the Fed make a move. Some of the Asian peers of India, the likes of Korea, for the first time in so many years, or China, have started the tightening cycle as well. The Reserve Bank of India was not sounding too dovish, even though they weren't sounding too hawkish for the near term as well. How big and how immediate a danger would that be for equity markets per se? Would it happen, to your mind, in the first half of calendar year 18, or is this pushed towards the second half?
I would say actually it's somewhere around in the middle. Q2, Q3 is where we get kind of concerned around the snapback risks. So it's not near term. I think Q1 is okay, but Q2, Q3, I'll give you some reasons. So firstly, we've done some work looking at the G4 central banks' balance sheets. And when we project forward, it's around Q2, Q3 where in aggregate, the growth starts to slow down. And that could lead to less hunt for yield in EM, and so capital outflows from EM. Another reason is the FOMC. It's going to be a completely revamped Fed FOMC committee, and it'll take some time to settle in with the new chair, vice chair, and so forth. But around Q2 could be when they start to change their strategy. And there is a risk they start to sound a bit more hawkish, maybe because fiscal stimulus in the US is going to be stronger with the tax cuts going through. And also, as I mentioned, maybe a greater focus on the financial stability risks as we get further into 2018. So enjoy the party, but I think we need to stay closer to the door with the equity markets as we start to get into Q2, Q3.
So what really saved us, markets like India in 2017 was the fact that dollar, after a very sharp up move, corrected quite a bit, almost gave up 2/3 of the gains, and our own currency kind of strengthened. What happens in 2018 in terms of dollar rupee, if you track that pair, or emerging market currencies in general and dollar, how are they going to move?
So we're actually, as a house at Nomura, we're actually fairly cautious on the dollar, because we think that compared to the ECB and the Fed, the risk of hawkish surprises we think are more for the ECB. And in addition to that, if you look at the current account, US has a current account deficit, Europe, particularly Germany, a massive current account surplus. So we actually expect the dollar to be continue to trade relatively soft, especially against the euro. When it comes to EM, you know, we look at all the Asian currencies. Where we're most bullish is actually India, Korea, and Thailand. So rupee, dollar rupee, we have at 63 for next year, by the end of next year. It might not seem that much appreciation against the dollar, but in total return, because of the higher interest rates, it should be a total return of over 4%, which is a pretty decent return.
Rob, so the key risk that you've just highlighted for 2018 for emerging market economies could be fiscal tightening by United States and also dollar strengthening, which will be a result of the fiscal tightening. But how much of a worry is it the economic slowdown in China? Does that worry you? Because there are some latest forecast which says that the GDP number next year could slow down to about 6.4% for China.
That's right. So we expect China growth to slow to 6.4 from 6.8% this year. China is starting to bite some of the more painful reforms like corporate deleveraging and SOE, state-owned enterprise restructuring. There is some risk that there could be some tremors originating from China and affecting global financial markets. It could be we see some corporate defaults. It could be we start to see a renewed capital outflows. But, you know, we don't see a hard landing in China. It's something very bad because China still has fiscal space to support the economy. And, you know, to put a bit of a positive spin on China, this slowdown in growth, it's moving to a more better quality growth. It would have been worse if China just continued to grow 7, 8, 9% and built up even more debt and built up, you know, more misallocated investment. That would have raised the risk some point in the future that China has the proverbial hard landing that would cause massive problems for the rest of the world. So in a way, China's starting to slow down because it's addressing some of its imbalances, is good in the long term for the world economy and India.
In fact, just before we wrap up this discussion, Rob, that was the final question. Where does India stand within this pecking order in EMs? Because there are concerns about the earnings growth in India vis-a-vis what's happening in the other markets, be it Korea, be it Philippines, be it Thailand for that matter. Some of those very small compared to India, but all of them are growing at a faster pace apparently for the next year.
I mean, when it comes down to it, I would say when I look across from sitting outside India and looking at India, comparing it to all the emerging markets that I cover, I would say India is my top pick in terms of the outlook, because we are starting to see a cyclical recovery. GDP growth is starting to pick up. We're forecasting 7.5% GDP growth next year. That's more than 1 percentage point faster than China. We see inflation, you know, picking up slightly, but it's still relatively, you know, good at 4.5%. It's not too high. We have RBI on hold. But the most important thing I would say is India's fundamentals. It might not feel like it looking at it from month to month, but you look back and I think India's fundamentals are in a lot better shape. Yes, there's a current account deficit, but it's almost fully covered by FDI. Inflation's a lot lower than it used to be. The budget deficit has not blown out. There's been a lot of supply side reforms. FDI is coming in. Ease of doing business is getting better. I think the key thing for India, and it will become more and more apparent, is this is not a boom-bust cycle. This is the start of a durable, sustainable, solid growth expansion. And there's not many big EM economies that you can say that about. So I'm very bullish on India. I regard it affectionately as Asia's tiger cub. And I think it's going to be very much part of the center of Asia economic dynamism in the coming 2, 3, 5 years.
Fair call, Rob. That's music to the ears for anybody sitting out here in India. Thank you so much for taking the time out and joining us and giving us that perspective. And have a good time in India.
Thank you very much. Looking forward to it.